In this video, we'll be understanding some concepts related to accounting. But before that, what is accounting? Accounting is a process through which we can record, classify, summarize, and then make analysis by preparing reports to assess the financial position of an entity. When we talk about accounting, there are certain terms or concepts, and without understanding them properly, we cannot adopt appropriate application of this framework. So, in this video, we will be discussing some important terms. So, the first term is business transaction. So, before understanding business transaction, we first understand what is business. Business is an entity that works in terms of generating money, and there are different definitions that state its meaning, but the major aspect is related to the commercial activities that generate economic benefits to its owner. While transaction in simple language, we just state it's purchasing and selling, but it is wider in scope because it covers too many aspects. Now, in combination, business transaction refers to an event which is purely financial in nature. In this, two parties are involved. For example, a shopkeeper who's selling goods in consideration of cash and earns profit is a business transaction. He is selling the goods in the market, he earns profit. So, this is a financial transaction and is economic in nature. Now, it has some features like goods has some value, it has money worth. This transaction involved exchange of goods and services, and it also affect the financial position of the shopkeeper. For example, when he's selling the goods, he's earning cash or money, and with the help of that, he's generating profit. So the financial position get affected, and it also affects the accounting equation. Now, what is accounting equation? It's also a new term. Accounting equation, if we talk in simple language, it's an equation that state assets is equal to liabilities plus equity. Now, these terms will be explained in detail. What are assets, what are liabilities, and what is equity. So we'll be discussing all these terms in the video. Now, next aspect it covers is the dual aspect concept. Now, what is dual aspect concept? Dual aspect concept states that there are two of every transaction, that is debit and credit. Now, debit in simple language, we say that debit is receiving, credit is giving in terms of benefits. But there are separate rules for each term, and these are based on the nature of account. Now, what is an account? Another term. Account is a format to record the financial transactions. Now, basically, when the transactions are recorded, they are classified in the next step in the form of account. In the example, we said that the shopkeeper is selling the goods to the client. For example, like if the shopkeeper X is selling goods to the customer Y in cash, so this transaction is recorded and classified in the form of account. X will open cash account in his books in which he records the transaction and then classify it in the form of account. It's a format, T-shaped format that is used to record the transactions. If we talk about the type of accounts, there are basically five types of accounts: assets, liabilities, expenses, incomes, and equity. All the terms are covered under this. So these are wider in meaning and they include several aspects. So we talk about assets. The next term, assets. What are assets? An organization whose valuable property, machinery, equipment that helps in generating economic benefits. So this is known as asset to a company. For example, if I'm running a bakery, then the equipments like ovens, mixers, refrigerator that I'm using in making breads or something, whatever in bakery. So these are all my assets because I'm using them to generate the income. Can be further classified as current assets and non-current assets. What are current assets? The assets that will yield benefit to the company, to the organization in a time span of 1 year are current assets. They have a capability of generating funds in shorter time span. So current assets can be further classified as first, cash and cash equivalent. Now, we all know what is cash. Cash can be coins, paper money, and money in our saving accounts. And the checks that we are having but not deposited yet are also considered as cash. Now, we know what is cash, but what are cash equivalents? Cash equivalents is no, it is not a direct cash, but it is equivalent because this is less risky. They are capable of generating money in shorter time period. Now, if it generate money in short time period, what would be the difference between cash and cash equivalent? In terms of immediate need of money, we can use cash, but we cannot use cash equivalent because immediately, if we want to use something, there is cash. Cash equivalent cannot be used immediately because it takes a little bit of time to convert into a cash. It has to be convertible. It is convertible in cash, but it is not immediate cash. These are kind of short-term investments. We know what is cash equivalent, but what are the types of cash equivalent? So cash equivalent is of many types. Some of the types we'll discuss in this video. Like first is the treasury bill. Treasury bill, which are also known as T-bills. Government issue these type of bills, and because these are backed by the government, these are less risky, and these are the safest investment. And they have a maturity period of less than 1 year, so these are less risky and easily convertible in cash. Next is money market funds. These are the funds that generate income, as these are safe, highly liquid, less risky, and short-term investment. Like any companies or banks who issue the short-term securities or mutual funds, which are short-term in nature, are types of money market funds. Next is certificate of deposits. Certificate of deposits is a financial instruments that are issued by the financial institutions. Now, what are financial institutions? Banks are financial institutions. Beside this, there are so many financial institutions that provide loan in case of requirement. It's a kind of deposit funds that we deposit with these institutions on which we earn interest. Now, if we are earning interest, what is the difference between cash certificate on deposit and saving account? Now, in this type of funds, we cannot withdraw the money, otherwise penalty will be imposed. These are deposited for a fixed time period on which we can earn interest. Next type of cash equivalent is commercial paper. Now, commercial paper are also short-term option that is available with the companies, but this is highly unsecured. Large amount of funds is involved, and the companies can raise money in case of requirement. Next is the banker's acceptance. Bank's acceptance means that the bank guarantee to pay bills like promissory notes that business issues while trading on credit. Now, what is promissory note? Promissory note is a instrument that is issued by the buyer, signed by him, in which he promises to pay a certain sum of money when he purchases goods on credit. So these are all cash equivalents. Now the next current asset is account receivables. Now what are account receivables? The accounts on which money is to be received yet are considered as accounts receivable, like debtors. Now what are debtors? Suppose X is selling goods to Y on credit, and Y is not paying the money when the sale is done. He is telling that he will pay after some time. So he becomes the debtors to the company. So the person from whom money is to be taken, they are considered as debtors. Under account receivable, there is another term, bills receivable. Now, what are bills receivables? So, bills receivable is a financial instrument which is issued to cater the needs of financial requirement of seller. Take similar example, X is selling goods to Y, and the transaction is done on credit. Now, for this, X will prepare a bill to which he send it to Y, and Y will give his acceptance by signing this bill. Now this bill become bills receivable for X. Now this bill receivable is highly beneficial, as in case of need, the X can get it discounted by bank and fulfill his financial requirement in case Y is not paying the money immediately. Now, the next current asset is stock or inventory. Stock or inventory is refers to the goods and services that are available with the company. This is of various kinds. Like if a company is new, there will be no opening stock. But if the company is old, there will be opening stock, which is left from the last year. The goods that are in production but not yet completed at the end of financial year are considered as worked in progress, and the goods that are fully prepared but not yet sold are considered as closing stock, and the closing stock of 1 year will become the opening stock of the next year. Next, current assets are short-term investments which are done by the company. Besides this, there are some prepaid expenses. Now, what are prepaid expenses? The expenses which are done for the next year also are covered under prepaid expenses. For example, X took an insurance policy on 1 June 2025, but the financial year start from 1st April 2025 to 31st March 2026. But in case his insurance policy started with the June will end by 31st May 2026. Now, the financial year closes by 31st March. So, April and May 2026, the expense of these 2 months is paid in advance, so this particular amount is covered under prepaid expenses, which is a current asset. Now, the other category of assets are non-current assets. Now, the non-current assets are the assets that are beneficial for the company for longer time period. These are also considered under different categories. These can be long-term investments, any property, plant, equipments that are held by the company, and there are certain intangible assets. Intangible assets are those that do not have any physical form but are still very valuable for the company. It consists of certain intellectual property rights like copyright, patent, trademark. Now, what is copyright? Suppose there is a person who has written his book and want to sell in the market, but there is a high risk that someone can sell it on its name. So, to avoid this risk, one can gain copyright and avoid this situation. Similarly, patents are issued for the new invention, and trademarks are kind of symbols that differentiate different businesses. Similarly, so these are all considered under intellectual property rights. Besides this, intangible assets also consist of goodwill. Goodwill refers to the reputation of company that is built over years. The value is calculated in accounting to consider the value of the business. Beside this, there can be software like technology, technical companies. For them, their software is their intangible asset. Even the license is also covered under intangible assets. Now, one aspect that there are certain assets which can be current asset as well as non-current asset. For example, furniture. Let's take an example of furniture. For an office, it is a fixed asset, non-current assets. But in case of a shopkeeper selling furniture for him, these will become current assets. So these are the terms. Now the next terms will be covered in the upcoming videos.